Thanks everyone for joining. We're going to be talking about personal finance for dummies, getting started, 101 stuff. Definitely open to taking questions. So if you got anything specific, definitely drop those in the chat. And we're going to do a little intro too, in case people don't know who we are. So I'll kick it off. I'm William Glass. I'm the CEO and co-founder of Ostrich.
Yeah, and I'm Andrew Holliday. I'm the COO and the other co-founder.
And he's got the good accent. I don't, but you know, it is what it is. And
that's on your point of view.
Good point. Good point. Speaking of which, you actually just came back from England.
I did, which is why we didn't do it, but now we are back, and we'll be back on a weekly, hopefully back on a weekly live, doing a different topic of personal finance every week.
Drop questions in the comments. We've got a few things prepared that we'll kind of walk through basics. Cool. Awesome. So, personal finance 101. I think the first place to start with this is, rather than jumping into topics right away and what you should do, is take a deep breath. Everyone has a relationship with money, whether you realize it or not, whether you recognize it, you've got one. And there's a lot of emotions that are often tied to personal finance. They can be positive, they can be negative, they can be everything in between. So before we dive in, just know that you're coming with some relationship to money. And I think that's just important to recognize. You don't have to change it. It'll change over time, but just recognize what that is. And the reason why I say that, and why I think it's important, is that there's so many different things that you can do when it comes to personal finance. And I'm going to give kind of an example of what we're talking about here. So we're going to be talking about Basics 101, things that everyone should do, but the order that you do them, how you do them, all that's going to vary based on your own, just your own abilities and interests. And so, for example, like, let's just say you're on a vacation and you're visiting a new city and you hear they've got this great gelato shop downtown. Now, there's a bunch of ways that you can get there, right? You could call an Uber, you could look up the maps yourself and drive, you could walk, you could just start off in a direction and hope it's the right direction. And that's kind of the analogy for personal finance. A lot of us just kind of start off either in a direction and hope we get it right. But I use the gelato example because there's a lot of things that we want to accomplish in life, whether it's buying a house, having kids, whatever those things are. And so that's your gelato shop. And the way that you get there is going to be different. It's going to depend on if you want to take the scenic route. Maybe you want to get there as quickly as possible. All of those things factor into Personal Finance 101. So that is laying the groundwork, and we can dive into more tactical things now.
Yeah. So I think, a good place to start is we're going to kind of assume that, we'll hope to help the most people that we can here. So we're going to make an assumption that, like, most people have got a checking account and a savings account. And for most people, you have like a regular income that's pretty consistent. And, we can do kind of deeper dives that'll get into what do you do if you've got more inconsistent income? What do you do if you work mostly with cash? And that'll be at another time. But for now, we're going to focus on what's most people's experience with personal finance. And so, I think when we think about where do you start, if you're just thinking about how do I organize my finances, start with looking at your last kind of 3 months of ins and outs. Like, what does your income look like? Know how much you're taking home after tax, start there, and then work back and look through your expenses. And you want to kind of put those into two buckets. You're going to do a fixed and a variable. So fixed, most people have housing costs, whether it's rent or a mortgage. Maybe you've got a car payment. You have commuting costs, maybe, the subway, loan minimum payments on debts, and utilities tend to be kind of the fixed costs. And the variable, food, kind of groceries, eating out, buying lunch, going out, cultural experiences, traveling, personal care, those kind of things. So those are kind of the two big buckets that we sort of think about. And what you want to do is get a good sense of, okay, I know what my after-tax income is, I know what my fixed expenses are, and I know what my average variable expenses are, having looked at the past 3 months. And like, it sucks to do that. It sucks to have to go through that stuff, but it's important to get to a place where you have a good sense of of your existing situation and what money you're going to have left over after you've covered all your living expenses, the way that you're living and spending at the moment.
Yeah. And the reason that's important is going back to the gelato shop, right? You've got to get the map. And so by doing that analysis, you essentially get your map of where am I today so that you can figure out where you want to go versus, just kind of wandering around blindly. And that's why it's super important to take the time to just analyze, as Andrew said, those expenses as well as your income and just figure out where you are. You don't have to do anything else to start with, but just figure out where you are.
Yeah. And there's a few different tools that you can use to do this. A lot of people have experience using like Mint or Personal Capital, where you can sign into all your bank accounts. It pulls all of your transaction data and automatically categorizes it for you. Those can be quite helpful. Excel has a tool that does the same thing. If you love spreadsheets, like I kind of love spreadsheets, because I kind of hate them. But there's plenty of ways to do it. You can do pen and paper if that's what you want to do. That's kind of the old-fashioned way, and it's probably the most effective. Forces you to look in the most detail, but it's certainly not necessary to do that. You can use these automating tools that are very good at what they do, and they'll help. And then, yeah.
And, if you're like most people, you probably have a primary account that you do most of your spending out of. If you get paid in cash, obviously it gets a little bit trickier. So there's obviously nuances to this, but the key is just get that baseline. And as Andrew said, use whatever tool is most effective to you. And a lot of, just like if you're familiar with Mint and Personal Capital and these types of tools, they aggregate everything into one place for you, which is nice. But now you can do this with pretty much any banking account. So if you have a mobile banking, you can actually do this in your preferred checking or savings account for the most part. So I think Ally does this, and Capital One, and a bunch of other providers do this as well. So you don't even have to use those tools. You can use one that already exists in your bank.
Yeah, correct. And so once you've got, you get through that exercise, that's the hardest work is kind of done. Then you can start to figure out, okay, you have an amount of money left over at the end of that exercise, hopefully every month, where you've covered your expenses and you have some money that you need to put to work. And this is where it starts to get a bit more exciting, and you can start to think about, okay, how do I get this cash working for me and helping me achieve my goals? And so we're going to run through the way that we think about, how should you start deploying that cash? And we have, based on our knowledge and our experience, we have an idea of how we like to approach this. But it's important to remember that, like Will said, with the gelato example, everyone's got a different way of getting to their destination. So this is not like the be all end all, but this is just how we think about it. So step one, emergency fund is very important. And there's a few different there's a lot of different advice out there on this, but generally you'll find that people will say 6 to 12 months of living expenses is best practice for an emergency fund. And that can be doesn't have to be the way that you live right now. It can be, okay, if I lose my job, then 6 months of living expenses might be very different and pared back compared to 6 months of living expenses when I have income. So, bear that in mind when you're thinking about this, but having that kind of cash buffer that will be there if you run into trouble, have unexpected expenses, is important. And this is, one of those things that a lot of Americans don't have. I think the stat is that a third of Americans have nothing in savings and another third have less than $1,000. So that emergency saving fund is something that a lot of people are missing, and a really important place to start.
Yeah. And it gives you a lot of power and flexibility and peace of mind, right? Knowing that if something happened and, God forbid you lose a job or income, or something, happens to a family member and you want to leave or quit, you have the ability to do that. And I think that's just super, super key, right? No one else is going to give you that money if you desperately need it and you have zero. So you've got to be able to provide for yourself and just have that safety net. So you're first building that safety net with an emergency fund. And again, to Andrew's point, your expenses will probably change. Like when we left to start Ostrich, we haven't been making money regularly, and so our expenses naturally change to reflect that versus what previously, when we had large incomes coming in. So that I think that's a really good point, Andrew, that you made.
Yeah. So after that, we're going to think about, and you can kind of think of this as 1A and 1B as opposed to 1 and 2, but 401k contributions or whatever retirement plan your company offers is the next big step, and making sure that you are contributing at least the amount that your company will match up to. Most companies will do a certain percentage of your salary. They'll match in your 401k, and this is just free money. So when you think about the value of that free money that's then going to compound over years and years and years in your retirement account, it's an outsized level of value that you get from doing that contribution. So that's kind of the next thing that you absolutely have to do is kind of get that sorted and underway. Comes out of your paycheck before you pay tax, so you won't even notice that it's really gone once it's set up. It just means that your paycheck is going to be an amount that's after you've done a 401k contribution, and that's key.
Yeah, and I think the other piece to think about is like, this is essentially giving yourself a raise, right? What's the easiest way to get a raise? If you have a match and you're not using it, that right there is free money. You don't have to ask your boss for it. You already get it. And two, you're paying yourself first. And as Andrew said, most 401ks, 403bs are traditional, meaning the money goes in before you pay tax. So if you put $100 in there, that doesn't mean $100 comes out of the money that you receive. It's more like, 80 or 70, right? So you're actually almost netting an extra $20 just by doing that. So
yeah,
that is, I think, a great place to start. And we can get into Roth, but for those that aren't familiar, 403b is the other option if you were in the public sector. So 401k, 403b, we might use those interchangeably, and those are just the same types of accounts.
Similar experience.
Yep.
So next thing, pay off high interest debt aggressively. So you should always be making the minimum payment on any debt that you owe, so that it's not in default, and that affects your credit report. It's bad news. Avoid that at all costs, like as much as you can. Make those minimum payments, but then any high interest debt that you've got, which is usually credit card debt, you want to pay off quite aggressively. This really hurts you from a personal finance standpoint. So pay that down aggressively after you've got your 401k contribution match sorted. I think question from Vince, can you convert a traditional into a Roth legally? Yes, you can, but you got to pay the tax on it when you do that. So if you can pick a year where you're going to make less money for some reason, like we recently have made less money, and a good time to convert a traditional retirement account into a Roth. But yes is the answer to that. You can convert. You're going to owe the tax when you do that.
Yeah, and so we should probably explain a Roth at this point too, since we've talked about it. So if you're confused what a Roth is, this applies for 401ks as well as 403bs, as well as individual retirement accounts, which are not through your employer. But there's something called a Roth, which is after tax contributions. It's still tax advantaged in the fact that all of the gains, the investment gains that you make in a Roth, are not taxed. So you pay the tax now. So if you think that you're going to be in a lower tax bracket now versus in the future, then a Roth is a great way to go. If you're just trying to maximize tax right now, or you think you might, retire on less because that's what you think, then it's better to do a traditional. Regardless, you want to take advantage of whatever you've got, either a Roth or a traditional.
Yeah, but if you're young, Roth is generally the way to go, because you're going to have a long period where your investments are going to make those gains, and you'll end up with that money being worth a lot. Like, for example, if you put 6,000 in to a Roth, which is the max contribution Roth IRA, this year, in 35 years, if you assume 6% return, it's worth, I think, about $50,000, and you don't owe tax on that money. So Roths are good. I would, if you're under 40, definitely favor a Roth. And funnily enough, that's step 4, is contribute to a Roth IRA. We just kind of walked through the benefits there, but very, very powerful account to have. And yeah, it's kind of a no-brainer. If you've got those extra dollars, put them to work, and yeah, your investment gains are tax-free. It's really, really excellent as far as giving you more flexibility when you get to retirement age.
And if you're using an IRA, so we've talked about 401ks, 403bs, and then we've talked about IRAs. The difference between an IRA, which is an individual retirement account, versus a 401k or a 403b is that a 401k, 403b are through your employer. Your employer has to provide those. You can't go set up your own 401k. It doesn't work that way. But an IRA, anyone can set up, just like you can set up a checking or a savings account. So this is something that everyone can do and should do, even if you're able to only contribute $10, because having the account will then give you the ability to continue to contribute in the future. As Andrew said, there are limits to what you can contribute. So if you have a 401k or a 403b, the limits are a lot higher. I believe they're 19,000 is the max. So if you have a high income, 19 and a half now, they're 19 and a half. So you can obviously contribute a lot of money into those. And then with the IRAs, the Roth or the traditional IRA, as you said, Andrew, the contribution max is $6,000. And that's not 6 in one and 6 in the other. That's a combined $6,000.
Yes. And, thinking about this in terms of where we are in the year right now, you have until tax day to contribute, to make last year's contribution, I should say. So even if you haven't opened an account yet, if you don't hold an IRA at the moment, you can open one today and do a contribution for last year up to that $6,000. And then in theory, you could do this year's 6,000 immediately as well. So you could do 12,000 in the space of 24 hours if you had the cash and you wanted to. But it's definitely worth kind of making that happen to the extent that you've got the money to do it before April 15th.
Yep. And that will help your taxes if you're using a traditional, and then obviously the benefits of compounding interest. I think the one thing to note, though, that a lot of people make a mistake of is with the IRAs, you are responsible for choosing the investments. So just contributing the money into the account doesn't mean that it's going to grow and you're going to have compounding interest. So there's an extra step where you have to invest that money. And we can talk about, I know some of our favorite things are just index funds, boring old low-cost index funds that track the S&P 500. So if you've ever watched anything about the stock market, that's usually one of the top things quoted is the S&P 500 and the NASDAQ. So you can pretty much just see how your money's growing based on how those indices are doing. So we can talk a little bit about that if that's a specific question, if people have questions about which ones we like, but that's another step that I've seen even in my own family, people making. So yeah. It's important to take that extra step.
Yeah, and we'll do another live another week where we'll kind of dive a little bit more into the specifics around investments, how to think about building a portfolio. Especially if you're lazy like me and you don't really want to have to look at it very often. So we'll kind of do a deeper dive on that in the coming weeks. But so once you've got your emergency fund, you paid down your expensive debt, you're contributing up to the match for your 401k, and you've done your IRA. Maxing out 401k is kind of the next thing. Will talked about it. 19,500 for last year. I think that's going up to 20.5 for 2022. Putting money into that, it just gives you flexibility in the future. The earlier you can be contributing to retirement accounts, the more it's going to be worth in the future because of that power of compounding. So it's kind of a no-brainer to do that to the extent that you have the flexibility and the ability to do it with those dollars. Trey, question on thoughts on the best time to convert traditional to a Roth when you're making the least money. It's the best time to do that. Or, assuming that your income is going to continue to rise, the sooner the better. If you're younger, the sooner you can get from a traditional to a Roth, the better, because you're going to pay tax on, the gains at that point in time. The more gains you have, the more tax you're going to owe, and the less time your investments are going to have to grow tax-free as you move into the future. So the earlier you can do it, the better, in my opinion.
And so on the maxing out, I think it's also important to note that any money that you're putting into a retirement account, you do not want to have to access that. That is not your emergency fund. That is your retirement fund. There are penalties if you have to access that money, and they vary. There's some benefits and things that you can do with Roth to avoid those. and traditional, but the idea is that that money is something that you're paying yourself, and 70-year-old or 65-year-old you will absolutely love it. But if you desperately need money, that's where you want to make sure that you've got that strong emergency fund. And then we're going to start talking about the next step, which is building savings for other things that are important to you. That could be, having a wedding over in England, for example.
Who would do that in the middle of a pandemic?
Yeah, I don't know. Somebody who's English. Right. And so that's where you want to also think about is you've got to balance this. And this is where there's no right answer. It's personal finance for a reason. So we're talking about kind of the best practices if you're trying to optimize, but this is just optimizing from a financial perspective, not from a happiness perspective. So you want to have that strong foundation, which is what we're advocating for. But when it comes to these other, gray areas, you want to be able to go actually buy that gelato now and then when you decide you want to go get something else or whatever the next destination is, you're set up for that as well. So that's the next piece, is make sure that you're putting money aside for other important things. It could be a vacation. It could be, like I said, a wedding. It could be all these other like life events that we think about.
Yeah. And you're going to want to think about how best to set yourself up with those. So short-term savings accounts are a good spot to put money aside for some of those nearer term goals. Think if you're getting married and hopefully you're not spending too much money doing it, then short term savings accounts a good spot for that. If you're thinking about longer term goals, maybe you are sensible and you start saving for a wedding 5, 6, 7 years before you're going to get married, maybe before you've even met somebody you think you'll marry. Or if you're thinking about buying a house, some of that cash you're better off putting into safe investments. You might want to buy bonds. Like at the moment, we're worried about inflation, so maybe you're buying TIPS, which are inflation-linked government bonds. Just to protect that cash and make sure that it's not devaluing over time because of inflation. And that was a question that we had before, before we started, from a friend of the show, Sean Leeks, who said, how should we be thinking about, shorter and longer term goals, particularly at the moment with, inflation kind of running rampant and in the news a lot. And, the Federal Reserve starting to think about raising interest rates to try and combat that. And that looks like, maybe sort of short to medium term, you are putting money into TIPS and, trying to make sure that your cash is keeping up with inflation. Longer term, if you're actively managing investments, like in your IRA, for example, as you should be, then, maybe you're looking at some inflationary hedging through investments, right? It might be buying gold. It might be buying commodities. Maybe it's investing in REITs that kind of tend to see the benefits of inflation as cost of housing goes up. But in addition to that, when you're thinking about retirement investing and longer term investing, you're going to see different cycles, right? So you want to invest in things that you think in the long term are going to be strong places to invest, right? Find industries, find geographies that you like. Invest in low-cost, boring index funds that cover those areas, and that over the long term, hopefully, unless we hit a massive inflationary bump, you shouldn't have to worry too much about shorter-term inflation.
Yep, I think that's great coverage on that aspect, Andrew. I think the other thing to think about as well is if you have extra cash set over, because we've talked about like saving for different life milestones and events and things like that. To your point, if they're longer term, you might want to actually invest that money. And this is outside of a retirement account. So use your brokerage account. You can use something like a Robinhood or a Schwab or an E-Trade or some of these other accounts now that have no trading fees or no commissions, trading fees, and you can invest. And I think, to your point, Andrew, it's going to depend on what your preference is. Are you someone that like actively likes to see what's going on and you're going to check it every day? Is that good for your health? these are all things that you have to think about, right? Because the market's going to be up and down, or are you better off just setting it and forgetting it, buying something that's going to do pretty well, like an index fund, which I'm pretty boring. I think Andrew and I both know we're both pretty boring when it comes to that. So the majority of what we do is very boring stuff. And then you can take a small percentage of your portfolio left over and do more exciting things, whether that's cryptocurrency, NFTs, buying, individual stocks that you really like Tesla or whatever that looks like for you. I think is important.
Angel investing in companies like Ostrich,
for example, yes.
It just came to me.
Yeah, if only we were raising around right now.
Yeah. So, I think that's kind of the final step is like, saving for those other goals. That obviously sounds quite draconian in a way, where you've got so many steps to get through before you get to the point where like, okay, now I can save for a big trip, or I can save for, the car that I've always wanted to buy, or, whatever that is. But I think, to go back to what Will said at the start, this journey is different for everybody. This is what we've just laid out is kind of in an ideal world, that's how you would put all of your cash to work in order, from our perspective based on our experience and knowledge. But that's not always the way that life works. And maybe you have emergencies that you've got to pay for, things that get in the way of that. Maybe you think that you really have to take that trip for your mental health and you want to go away, and that's fine. So you kind of divert some of your dollars towards that savings goal before you've, fulfilled everything else on that list. And that's okay. It's kind of a personal choice for everybody else. For each person, even, I should say. Question from Quan. How do we feel about banks reducing or eliminating overdraft fees? Answer, fantastic. That's how we feel about that.
Should have happened ages ago.
Yeah. It's about time. Really no downsides to this. The more banks that do it, the better. I know Bank of America has kind of reduced theirs, and I think kind of Chase has increased the amount of dollars that you can be overdrawn by from 5 to 50. So we're moving in the right direction. And like Capital One, I think, has got rid of them completely now. Ally has, as well as told me in the past, and as I know now, they got rid of theirs completely. So it's good. Definitely moving in the right direction. It's great to see that happening. I don't know if you've got any other thoughts. Well, I don't think there's any downsides to that whatsoever.
Yeah, I don't think so either. Typically the people at Overdraft are the ones that are in the toughest financial situations, right? So why would that be a bad thing? And I think that's kind of our ethos, right? Like, for what we want to do is we want to help people just do the things that they want to do in life. Maybe finance is something that you really love. Maybe it isn't. And that's where we can come in. So you may know that all I want to do is I want to buy a house. That's the number one thing I care about. We'll help you figure it out. And so that's kind of our thought process. And any financial service institution product that can help you achieve your goals better, quicker, and without putting you down the wrong path, I think is something that we support.
Absolutely.
What other questions do you guys have? Does anyone have any other questions?
And, we'll be doing more of these in the future. So there will be opportunities to ask more questions, and, you can reach us offline, and we'll be happy to kind of discuss them, those questions in future sessions that we do, especially if you've got more specific things. We'll be doing deeper dives into saving, investing, paying down debt strategies, and, donating your cash as well, if that's something you're interested in.
Yeah, or if there's any topics that you'd like to see, feel free to drop those, because we've gotten some on student loans in the past and things like that. So we're definitely happy, and definitely got one on portfolios specifically, so we can go into the investing side. Yeah,
we'll be doing those more regular cadence. Hey, maybe it's Thursday nights, maybe it's not. Who knows? We'll keep you on your toes. But yeah, we'll definitely be doing this, and then everything that we discussed today, you can find. I think we'll post this video right to either your profile or hopefully to Ostrich as well.
We can post it across all of them. Yeah, I think I'll download it, and then I think I think it'll automatically be on mine, and then we'll have to upload it to Ostrich and to yours. But
so this video will be available, but I think it's kind of more ideal with this stuff to have it written down as well. You can find this stuff on our website, getostrich.com, to be able to go through it at a bit of a slower pace if you want to. Hopefully it's useful. Send us messages if you got any feedback and suggestions, and we'll be back soon.
Yeah, and if you haven't, go to getostrich.com and put your name on the wait list. App's coming soon.
Yeah. All right.
See ya.
Bye for now.